Hello everyone, welcome to EduTap and welcome to today's session. So today we are going to discuss two very important notifications that has been released by the Reserve Bank of India. Direct questions can come from these notifications in the examination, so they are very important, okay? So the first notification that we are going to discuss is regarding the framework that has been released for the compromise settlements and the loan write-offs. The second notification is regarding the issuance of the guidelines that has happened for the default loss guarantee. So what is this default loss guarantee as well as what are the guidelines? So we are going to have the complete understanding of these notifications. Now before starting with the two important news articles, two notifications, do subscribe to the YouTube channel of EduTap and join our Telegram channel for the PDF of this session, okay? So now starting with the first news article, that is regarding the Reserve Bank of India's framework for the compromise settlement and the loan write-offs. So the RBI has issued the comprehensive complete regulatory framework governing the compromise settlements and the technical write-offs covering all the regulated entities. So the Reserve Bank of India is the regulator and there are the different regulated entities under the Reserve Bank of India. So this framework, these guidelines are for all the regulated entities that are under the regulation of the Reserve Bank of India. And see, the compromise settlement, that means settlement is happening. So what happens that when loans, so the regulated entities like the banks, the NBFCs, they provide the loan. Now when this loan is turning into a non-performing asset, when this loan is becoming a stressed asset, so what happens that the banks and the NBFCs, they have this stressed asset now. So to settle this stressed asset, to get some money back, there is the compromise settlement that can happen and there is also the technical write-off that happens. So now we will understand the complete framework for this compromise settlement and the technical write-off, but I hope you have understood the basic understanding that in the case of the stressed asset, in the case of the non-performing asset, the compromise settlement and the technical write-off happens. So until now, there was the prudential framework that was present for the resolution of the stressed asset. So in 2019, this kind of framework was released for the stressed assets, okay? So now but this framework was only for the selected regulated entities, like for the scheduled commercial banks excluding regional rural banks. It was present for systemically important non-deposit taking NBFCs and the deposit taking NBFCs. So it was not present for the other small non-deposit taking NBFCs. So you can understand that all the regulated entities were not covered under this kind of resolution. So now the RBI has said that in view to provide further stress for the resolution of the stressed assets, so that the stressed assets can be resolved by the regulated entities, can be resolved in the economic system of our country, as well as to rationalize and to harmonize the instructions for all the regulated entities. So all the regulated entities are following the same norms for the resolution of the stressed asset. So it has been said that we are bringing a new framework, okay? So this was said in June 2023 in the statement on developmental and regulatory policy. So this was said, and in the same month only the new framework has been released. So in the statement on developmental and regulatory policies, the Reserve Bank of India decided to issue a comprehensive complete regulatory framework governing the compromise settlements and the technical write-off covering all the regulated entities. So the new framework covers the provisions of the new framework is applicable to all the regulated entities, all the commercial banks including the small finance bank, local area banks, regional rural banks, the primary urban cooperative banks, even the state cooperative banks and the central cooperative banks, okay? All India financial institutions and all the non-banking financial companies including the housing finance companies. So all the regulated entities has to follow the new framework. So the framework for compromise, the new framework, let's understand this. So the regulated entities have to put in place the board approved policies for undertaking the compromise settlement with the borrowers, as well as for the technical write-off there should be the presence of board approved policy. So what is this compromise settlement and what is this technical write-off? So compromise settlement is the settlement that is happening between the regulated entity that has given the loan and the borrower. So the compromise settlement is happening between the regulated entity and the borrower. It is the negotiated arrangement in which the borrower is settling the claims of the regulated entity. And what is happening, let's say the 2 lakh. So the loan was of 10 lakh. Out of this 10 lakh, 8 lakh has been paid by the borrower. Now the borrower is not able to pay the 2 lakh because the borrower is in any kind of financial difficulty. So the regulated entity is saying that, okay, just pay us 50,000 and we are waiving off your 1,50,000. Okay, we are waiving off your 1,50,000. Just pay us the 50,000. So this is the compromise settlement that is done. The borrower is paying the 50,000 and the regulated entity has waived off this other extra amount. So what has happened, that the relationship between the regulated entity and the borrower is finished now. So this is the compromise settlement. This is the negotiated arrangement with the borrower to fully settle the claims at a one-time settlement process. It may entail some sacrifice of the amount due from the borrower on part of the regulated entity. So the regulated entity is making the sacrifice of some part of the loan, of some part of the amount that is due. Okay, so the sacrifice has to be made by the regulated entity. That is why it is a compromise that is made by the regulated entity, that at least the whole money, the whole 2 lakh is not coming back. So the regulated entity is saying that at least pay us some. At least pay us some. Okay, so the waiving of the claims happen by the regulated entity against the borrower to the extent. Now technical write-off. So compromise settlement, I hope you have understood the basic idea. It is a one-time settlement in which the relationship between the regulated entity and the borrower is finished. The regulated entity has given the waiver off to the borrower and the borrower is just fully settling the claims by paying a small amount. Technical write-off here means that for the accounting purpose, the complete non-performing asset has been written off from the accounts of the bank fully or partially. It can be fully written off or partially written off. Still the borrower, in the borrower loan account, it will be shown and the borrower has to pay. Just from the accounting book, just from the accounting purposes, the bank is not showing the NPA in its own accounts. So the technical write-off shall refer to the cases where the non-performing asset remain outstanding at the borrower loan account level. That is, the borrower has to pay the loan but are written off. So these non-performing assets are written off fully or partially by the regulated entity only for the accounting purposes without involving any waiver of claims against the borrower. So no waiver has been given to the borrower. So there are, so we've discussed about the board approved policies, right? So what happens that this person, this entity in a bank, let's say some manager in a bank has given the loan. Now this loan has become a stressed asset. This loan is not coming back. This loan has turned into a NPA. Now the compromise settlement or the technical write-off has to be done by a higher authority than the authority that has given the loan. Okay, so the approval of the compromise settlement, the approval of the technical write-off has to be done by a higher authority and the reporting has to be done to another higher authority. So there shall be reporting mechanism to the next higher authority at least on a quarterly basis. On the quarterly basis, the reporting has to happen to the next higher authority with respect to the compromise settlement and the technical write-offs that is approved by a particular authority. So a particular authority is giving the loan, the next higher authority is doing the compromise settlement, is doing the technical write-off, and the next higher authority has to be reported regarding the whole process. Okay, and in the, so the board approved policy also tells about the complete compromise settlement, that what percentage of the settlement can happen in which cases, as well as the board approved policy should be there regarding the responsibility that has to be taken by a staff member when a loan is becoming NPA. So above then a number, above then an amount, if the loan is becoming NPAs, then the staff responsibility has to be seen, that is the staff responsible or not. For that also the board approved policy should be there. Okay, so I hope you have understood that the framework tells about the compromise settlement and the technical write-off. What is the meaning of these is told in the notification itself, as well as the framework has told that there should be the board approved policy for determining the responsibility of the staff in case of the stressed assets, as well as for the reporting mechanism for the whole mechanism. Okay, any arrangement that is involving part settlement. In the compromise settlement, we have seen that the relationship between the bank and the borrower is finished. But there is also the part settlement that is done with the borrower sometimes. So this falls under the restructuring category. Restructuring is an act in which the lender, in which the regulated entity, for economic or legal reasons relating to the borrower's financial difficulty. So the borrower is in a financial difficulty, and that's why the regulated entity is providing grants, concessions to the borrower. This restructuring may involve the modification of the terms and conditions of the advances, such as the alteration of the payment period, that okay, you have paid from out of 10 lakh, you have paid 8 lakh, you are not able to pay 2 lakh. So what you can do, that we are waiving off your 50,000. You do not have to pay 50,000, just you have to pay 1,50,000, and right now pay 25,000, and in the 1 year period just pay us 1,25,000, and the interest rate has been reduced in this also. Okay, so what has happened, that the alteration of the payment period has happened. Before, the person had to pay this 2 lakh right now, but now it has been said that okay, you get 1 year timeline. Payable amount has been reduced from 2 lakh, now the amount has been reduced to 1,50,000. Amount of installments can be increased, rate of interest can be altered, can be decreased, sanction of additional credit facility. So these all are the restructuring, that the relation between the regulated entity and the borrower has not finished. The borrower is liable to pay to the regulated entity, just the loan has been restructured so that the borrower can easily pay the money. Okay, restructuring in general entails the lenders having a continuing exposure. So here the regulated entity is connected, it is having a continued exposure to the borrower entity even after restructuring, because the restructuring means just you are providing better terms and conditions to the borrower, better conditions to the borrower, seeing the financial difficulty of the borrower. On the other hand, compromise settlement means a complete detachment of the lender and the borrower, that the relationship between the lender and the borrower has finished. Compromise settlement, if the payment under the compromise settlement is happening like the payment, the settlement in the compromise settlement should happen within 3 months. If it is not happening within 3 months, then it will come under the restructuring. So the compromise settlement, where the time for the payment from the borrower of the agreed settlement amount exceeds 3 months, shall be treated as restructuring. So if you are giving more time to the borrower to pay, then that means this should come in restructuring. So the compromise settlement, where the time for the payment to the borrower of the agreed settlement exceeds 3 months, then that shall be treated in restructuring. Even in the compromise settlement, there can be 2 installment, 3 installment, but it should happen within 3 months. Okay. Now coming to the framework of the cooling. So in the framework, there was also the mention of the cooling period in respect of the borrowers that are subject to the compromise settlements. That is, their loan has become stressed asset for the bank. So in this case, there should be a cooling period, that you are doing the compromise settlement, the bank is doing the compromise settlement, that means the payment is not coming back. So there should be a cooling period as determined by the board approved policy before the regulated entities can provide fresh exposure to such borrower that has gone under the compromise settlement. That's why it is said that you should not do compromise settlement, because if you are doing the compromise settlement, means your stressed asset is present. There was the stressed asset, there was the loan that you were not returning. So you have to return the loan on the timely basis, you have to pay your EMIs on the timely basis, and so your loan is not coming into the stressed asset category, because if it comes under the stressed asset category, that means there is some problem with your credit risk profile will appreciate. Okay, there will be detrimental effect. So the regulated entity for any fresh exposure to such a borrower that has gone under the compromise settlement, for such a borrower there should be a cooling period. So the cooling period in respect of the exposure that is happening other than farm credit, that is for non-farm credit exposures, there shall be the minimum cooling period of 12 months, that is till 12 months the regulated entity cannot provide the loan to such a borrower. Regulated entities are free to stipulate higher cooling periods in terms of board approved policy. For the farm credit exposure, the cooling period has to be decided by the board approved policy. In the case of the technical write-offs, the board has to decide the cooling period. Okay, so compromise proposals for compromise settlement. So the debtor that has taken the loan, the borrower, can be classified if it is classified, if the borrower is classified as fraud or willful defaulter, that the person has money, still the person is not giving the money to the bank, it is the willful defaulter, it is a fraudster. The person is a fraudster. So in the case of the fraudsters also, the compromise settlement can be done by a bank, because the fraudster is not giving any money, so the bank is saying that at least give us half of our amount, or 75% of our amount, or 25% of our amount. Okay, so I hope you have understood this, that the regulated entities may undertake compromise settlement or the technical write-offs in respect of accounts categorized as willful defaulters or fraud without prejudice to the criminal proceeding that is underway against such debtors. But restructuring should not happen with the fraudster or the willful defaulter, because the fraudster is a bad person, we can say, and the relationship between the regulated entity and the fraudster should not be present, and that's why with the fraud or willful defaulters, there should be direct settlement that should happen, one time settlement that should happen. Okay, coming to the next news article, RBI gives green signal to the first loss default guarantee framework. So the RBI in its statement on developmental and regulatory policies document that was released in June 2023, the RBI said that based on extensive consultation with various stakeholders, it has been decided that the RBI will be putting in place a regulatory framework for the permitting of the first loss default guarantee, or what we call it as the default loss guarantee. Okay, so, arrangements in the digital lending. So the RBI in June 2023 itself has released the notification regarding the complete framework, complete guidelines for the default loss guarantee arrangement in the digital lending. So the RBI has granted its approval for the first loss default guarantee framework, and the first loss default guarantee framework has been released. Okay, guidelines are applicable on all the commercial banks, including the small finance bank, all the primary urban cooperative banks, state cooperative banks, central cooperative banks, on all the non-banking financial companies. All of these have to follow these guidelines. So the digital lending, I hope you have heard about the digital lending. That is the lending that happens through the electronic platforms, through the digital platforms, through the digital lending apps. The digital lending is happening where the service providers are promising you the money within 1 day, loans within 1 day, or within an hour, or within 2-3 hours. So this is done. The digital lending is when the banks or the big NBFCs, they are partnering with the fintech companies, with the financial technology companies. Okay, they are the lending service providers, or they can be any NBFCs also, small other NBFCs, other regulated entities. So the banks and the NBFCs are partnering with the lending service provider, that is acquiring the customers. Okay, that is connecting with the customers, that is acquiring the customers, that is taking the basic information of the customers like the Aadhaar card, PAN card, and that is saying this bank to provide the loan to the customer. Okay, so through this kind of service is provided, so that the banks or the NBFCs they can acquire more customers. Okay, so the lending service providers are the associates or partners of the banks or the regulated entities, other regulated entities, and they are acquiring the customers, they are doing the customer acquisition, and they are through the banks and NBFCs, the loan is provided to this customer in a very fast manner. Okay, so this is happening, and the convenience fees is provided to this LSP. Now so this is the kind of process that happens in the digital lending. Now if the customer is not paying back the loan, if the customer is defaulting on its payment, so now the bank is the one that has given the money, so the bank is the one that is not getting the money back, so the bank will be in big loss. So in this case, it was said that the LSP should also have some credibility, the LSP should also have some responsibility, because the LSP is the one that acquired that customer, that provided or got the basic information from the customer, and that said to the bank that yes, we can provide loan to this customer. So the LSP should also have some responsibility in this case when the customer is not paying back. Otherwise, the LSPs will continue giving or collecting the information of such people and saying to the banks that give the loan to such customers that the LSP knows will not pay back. So this could also happen. So the responsibility should be with the LSP also. so that the LSP are more careful. Okay, so first of all, default loss guarantee. See, this is a guarantee, this is a contractual arrangement between the regulated entity and the lending service provider that is partnering up with this regulated entity. The lending service provider can be some fintech company, or it can be other regulated entity like the NBFCs or the banks, other banks. So the lending service provider should have some responsibility when the lending service provider is providing the customers or is saying to the regulated entity that okay, provide the loan to this customer. So the LSP should have some responsibility. So the contractual arrangement has to be signed between the regulated entity and the entity under which this lending service provider, which should guarantee to compensate the regulated entity in case the default is done by the customer. That is, loss is faced by the regulated entity due to the default up to a certain percentage of the loan portfolio of the regulated entity. So this is the default loss guarantee. Eligibility of the DLG provider. So who should provide this default loss guarantee? The regulated entity may enter into a default loss guarantee arrangement only with the lending service provider that is providing the outsourcing arrangement, or that is providing the digital lending service on behalf of this regulated entity, that is partnering up with this regulated entity, that is partnering up with this bank or NBFC. Okay, so the LSP providing the DLG must be incorporated as a company under the Companies Act 2013. Okay, so we have understood that okay, the default loss guarantee, it has to be provided by the lending service provider to the regulated entity. Okay, now how much of the guarantee has to be provided to the regulated entity? So there is the cap. Okay, there is the maximum limit. Regulated entity shall ensure that the total amount of DLG cover that is provided by the lending service provider on any outstanding portfolio should not exceed 5% of the amount of the loan portfolio. So I hope you have understood. See, the lending service providers are the small fintech companies, they are the small NBFCs, or they are small companies. Okay, so they cannot provide much of, they do not have much of the capital for themselves, so they cannot provide huge guarantees. So even 5% of the guarantee will be enough that can be provided by the LSP, and it is just for the LSP lending service providers to be more responsible, because they know that they will also face loss if the customer is defaulting. So they have to be careful when they are acquiring some customer. Okay, invocation of DLG. So the regulated entity shall invoke within a maximum overdue period of 120 days unless made good by the borrower. So the regulated entity has to invoke the default loss guarantee within a maximum overdue period of 120 days. If the borrower has said that okay, I'm in the financial difficulty, I'm going to get my payment in 90 days and then I will pay. So it has to be between the bank and the customer. Okay, so made good by the borrower. I hope you have understood. Now, tenor of DLG. The period for which the DLG agreement will remain in force shall not be less than longest tenor of the loan in the underlying loan portfolio. So loan portfolio, a loan has been given for 5 years, a loan has been given for 3 years, a loan has been given for 2 years, and the DLG is provided of 5% of, let's say, 4% for the total loan portfolio. Okay, outstanding loan portfolio. So this 4% DLG that is provided should be for the maximum period of the loan, that is of the longest tenor. Okay, so I hope you have understood that the loan for the longest tenor, as per that time period, the DLG agreement should be formed. Okay, so the DLG agreement will remain in force and shall not be less than the longest tenor of the loan in the underlying loan portfolio. Disclosure requirement. The RE shall put in place a mechanism to ensure that the lending service providers with whom the RE have come into the DLG arrangement shall publish on their website the total number of portfolios and the respective amount of each portfolio on which the DLG has been offered. So this has to be done by the lending service providers, so that the regulated entities are also able to know that this lending service provider is under these contracts, is under these arrangements. Okay, so due diligence. The regulated entities shall put in place a board approved policy before entering into any DLG arrangement. Okay, as well as the regulated entities should also be more apprehensive and should also be more responsible. They should not leave all the responsibility on the LSP, that the lending service provider is the one that will only check the documents, we do not have to do anything, we will sit back. So that should also not happen. Okay, So you can read the due diligence. It is reiterated that the DLG arrangement shall not act as a substitute for the credit appraisal requirements. Okay, the credit appraisal has to be done by the banks, and robust credit underwriting standards need to be put in place irrespective of the DLG cover, that the banks have to be apprehensive. Okay, so this much, like I have told you, the important points that you need to remember, especially remember that the 5% is the maximum, shall not exceed 5% in the DLG cover. Invocation of the DLG should happen maximum overdue period within maximum overdue period of 120 days, as well as the DLG can only be provided by the LSP that is connected with the regulated entity. Okay, now coming to the questions, this is the first question that I hope you can easily answer. And here you have to tell that which of the following statements is incorrect. Just the basic understanding you need to have regarding the guidelines and the framework. So the second question is regarding the DLG cover. The DLG cover should not exceed what amount of the loan portfolio. The third question is regarding the technical write-off and the compromise settlement. Here the cooling period for the non-farm credit should be what? So EduTap has brought for you the comprehensive guidebook for RBI, NABARD and SEBI, so that through a single guidebook you can get all your common queries answered. If you want to know about the syllabus of the examination, the complete syllabus has been provided in this single guidebook, as well as the sources for your preparation for the examination has been provided in this single guidebook. Even the previous year questions for your practice is provided. So and this all is absolutely free of cost. These guidebooks are absolutely free of cost. You can download these guidebooks. The link is provided in the description box below. So do download these guidebooks. Thank you very much. If you have any query, you can mail us here or you can contact us through this numbers. Thank you very much, everyone.